Hi, good evening, ladies and gentlemen. Can you hear me? If you can, kindly type yes in the comment box, please, so that I know that I can continue. Thank you, Dave. Okay, so I assume the rest are able to hear me, so I will proceed with today's session. Thank you, Shirley. All right, so today we're going to discuss about undervalued stocks and growth stocks. Okay, there are many different kinds of stocks out there. There are many different kind of investment strategies, and I think that given the age of internet, there is a lot more information than what investors are used to in the past. And the good thing is that yes, you can get information quickly at your fingertips. But the downside of it is that sometimes it can also get very overwhelming when it comes to investing. And that's why today I want to clarify certain points with you and certain concepts with you so that it can help you make better investment decision right at the end of the day. Okay. And also understand that there are different approaches to the stock market. And it doesn't mean that one is better than the other. You must also understand that each strategy will have its pros and cons. There are periods where a particular strategy will do well. There will also be a period where a particular strategy will not do well. So there's no one strategy that can always do well in the market. So that's something that you must also understand. Right? So there are a lot of all these concepts that an investor, the more informed investors will need to know and incorporate into your own investment strategy as well as expectation. Okay. So let me introduce myself. I'm Alvin, the CEO of Dr. Wealth, invested in the market for over 15 years. I've written books like Secrets of Singapore Trading Gurus and Singapore Permanent Portfolio. You might see me in some of the media before. I've done a Money Mind session a few times. The last one was about SGS bonds. Okay, if you have caught it, you might have seen me there. And I started a company with three other friends about 9 years ago, right? Coming to 10. And along the way, we had more shareholders joining us, like Dershing and Shaoning, who used to run Job Central. They sold their business. Now they are angel investors. We are not investee companies. And we also have Philip Securities, one of the largest stock brokerage firm in Singapore, is also a shareholder. So this is just to give you a glimpse who is behind the company and assure you that we are not some fly-by-night company, and we are backed by credible people and companies. And we also work with financial institutions. I'm also an SGS Academy trainer, doing some programs over there. And there's one that's coming up tomorrow, which is together with Maybank to talk about Singapore SDR as well. Okay. So today I want to talk about two particular strategies, okay, more suitable for long-term investing, and the other one is more mid-term investing. Okay, you always hear short-term and long-term, right? You rarely hear mid-term. Okay? And I also think that it's important to clarify what we mean by long-term. Maybe I just ask you, right? What is a typical time frame when somebody say long-term? What is it to you, right? Does it mean like 1 year, 2 year, 5 year, 10 years? What does long term mean to you? I just want to get a sensing, right? Because you always hear people say, "Wow, long term, long term, long term." But what does long term mean, man? Because different people give you different numbers. Okay, so what do you think? Stanley say 3 to 5 years. Okay, couple of the rest. CKO say minimally 2 to 3 years. In-house say 3 years. 5 years, 2 to 3 years. Okay, so it seems like most of you believe that long term is 2 to 3 years. Okay, so my that's why it's important to clarify. So to me, 2 to 3 years is more like a midterm. It's not say very long term. 2 to 3 years, you can't even ride a full, say, a bull cycle or a bear cycle. Okay? Maybe bear cycle can, because bear cycle is usually shorter. But a bull cycle usually a lot longer, right? It can be 5 years and beyond. Okay, so to me, long term should be at least 5 years. All right. Okay, so that would get us out of the way. And usually, if it's less than 1 year, I would say short term. Okay, so these are just my definition. Don't take this as gospel truth, because as I said, if you ask other people, they may have very different answers at the end of the day. So you can put 1 to 5 years as midterm to make sure that this number tally. Okay, so this is my definition. And why I want to go through this is also because sometimes you hear people give, say, financial advice or financial comments or views online, and maybe the person time frame is midterm, okay, 1 to 5 years, right? But then the person may say, oh, this is a long-term investing. If your definition is different from that person's definition, right, you might have a window that's very different, and then the strategy sometimes or the stock may not work when outside the time frame. Okay, so this is why I think there are a lot of intricacy in investing that a lot of people don't realize. And given our current state of environment where we have instant gratification, okay, and we want a lot of information in the least number of words or a short video as much as possible, but sometimes certain details is just cannot omit. Okay, so sometimes if you see someone make a particular comment, it's important to ask a little bit deeper. Right, so you say long term, what is the time frame you're looking at? The answer might surprise you, might be different from what you define as what is long term. Okay, so that's one aspect that I wanted to touch on. And so today's two strategy that I'll go through with you, right? One is called buy low, sell high. Okay, this is what you always hear. This is more like a midterm strategy. Okay, sometimes the strategy or the stock that you buy can realize in 1 year, can realize in 2 years the gains. It depends on the market situation and the conditions. Okay, so this is something that we cannot predict. But if you've done your job well, you should be rewarded eventually. And the other one is buy and hold, right? So it's also a very common term that you hear. This is more on a long-term kind of perspective, right? Holding means that you generally don't want to sell, okay? Whereas the first strategy, you have an intention to sell and you do want to sell. So there are cases where buy and sell is suitable, and there are cases where buy and hold are suitable, okay? And you need to differentiate, all right? Most people I encounter is that they usually do both, right? But usually they buy low, sell high, right? It's those stocks that they make profit, okay? And then the ones that they make losses usually just buy and hold. Yeah, correct or not? Correct me if I'm wrong. Usually, this is the case. Okay. It is not strategy dependent, it's outcome dependent. It depends on whether you make money or not. You make money, I sell. I don't make money, I hold. Wait until you go up. Okay. This is not necessarily a right way to approach investing. Okay. It should not be outcome driven. Okay? That means you don't determine a stock is worth to sell or not based on whether you make money or not. Okay. You should buy based on fundamentals, then you should also sell based on fundamentals. Okay, because usually, right, when you talk about midterm and long-term investing, right, it's usually the fundamentals that matters. Okay, that's another aspect, right? Some people say fundamental, technical analysis, then they keep arguing which one is better. It's not that which one is better, it's dependent on the time frame. It really, the time frame has a lot more impact on it. So in the long term, the fundamental plays a bigger role. In the short term, technical analysis play a bigger role. Okay, so if your time frame is less than a year, you use fundamental analysis for what? No point one. It's not going to work. Okay, so using the right technique in a wrong time frame will also cause you poor performances. Okay, so you must also know when to use what, right? So generally, shorter term period technical makes more sense because in the short term it's driven mainly by sentiments. Okay, and in the long run, it depends on business performance. And that's why your fundamentals play a bigger role in a longer period. So today's strategy is definitely more on the fundamental analysis, right? Because we are looking at a longer time frame. Okay, so whether you going to use buy low, sell high, whether you're going to buy and hold, generally the fundamental analysis should take precedence. Of course, some people will say, wow, there's no harm I add a little bit of technical analysis to time better, right? It's possible, okay? But if you want to hold a longer period of time, the fundamentals are more important than the technicals, okay? So I hope that help you have like a framework to decide what to use. Okay, at the end of the day, all these are tools, right? It's just like you have a toolbox. It doesn't mean that every problem you have, right, the hammer will solve it for you. Sometimes you may need a plier, sometimes you may need a spanner. So it really depends on the situation. So if you use the right tool at the right situation, then you get the results. Okay. So sometimes you use the right tool in the wrong situation, then that's why you don't get the results. Okay. So this is something that you must put things into context. All right. So let's go through some other details. And this is what I want to warn you about. Okay. Right. Remember just like I said, usually if people have profits, they will buy low and sell high. Okay. And then if they have losses, they buy and hold. The thinking is that if I hold these losses long enough, right, eventually they'll become a profits. It's almost like saying that if I hold the weeds long enough in the garden, they will become flowers, right? You know that it sounds very ridiculous, okay? But in the investment field, that's what we do, right? Because losses are painful to take. The same amount of loss, right, hurts you 3 times more than the joy of the equivalent gain. Okay, so for example, if you make $1,000 and you lose $1,000, right? The joy versus the pain, okay, the pain is equal to 3 times the joy, right? Even though the amount is equivalent on either other side. So because of this loss aversion, this is what psychologists say, loss aversion, we tend not to want to sell losses. Okay, but I guarantee you that every investor will have losses. Guarantee. Even Warren Buffett have losses. Even Temasek have losses. There is no one investor that can get 100% hit one. Right? If someone tells you what every stock he sure make money, man, it's a liar, it's a scam, it's a fraudster. Please don't get scammed. So if every investor is going to have losses, right? It is important how you deal with these losses as much as how you deal with the gains. Okay, so the earlier we can recognize the mistakes and admit it and move on by selling them is better. Okay, I know it's not easy to say, but it's not easy to do. Yet this is something that I need to emphasize. Okay, I will tell you why. Right, holding a stock long enough will not solve your mistake, will not correct your mistake. Okay, so this is the statistics, and I want to warn you. Okay, there are only few stocks at the end of the day that are worth to buy and hold, which means really just hold, don't need to think so much, right? Because most businesses fail. Remember, you hear of this before, right? Most businesses fail. And when you buy stocks, they are essentially businesses. And most of them will fail. That's the odds. So the longer you hold, the chances of a company failing is higher. Okay, and that's why a lot of businesses run into problems. Sometimes they don't go bust, it's fine, but their business is not as good as before. Your chances of hitting these kind of stocks are very high. So majority of stocks will not make it on. And that's the fact. Okay, so if you think that if I hold long enough and I can make a profit at the end of the day, it's not true, right? It's better that earlier you get rid of the mistake and move to the right ones. Then some stocks are meant to be traded, not meant to be held. Okay, they may be very undervalued at situation at a particular point in time, and when the price rebound, you sell them for a good profit. And you better sell them, because if you don't sell them, the price will go down. I believe you experienced that before as well, right? You did buy some stocks undervalued, share price move up, but you didn't sell, and then you see the share price go back to your share price that you bought. Okay, so in these cases, knowing when to sell is important. You cannot just blindly hold. Okay. And lastly, in fact, majority of the stocks are trashy. They are not worthy enough. Not even worth to buy and sell. Okay. These stocks you should be avoided. So more than 50% of the stocks, you should not be even looking at them. At any exchanges, even in the US, more than 50% of stocks are not worth your time and money. Okay, so these are the odds that we are looking at. All right. Then this is a research to give you that numbers. Okay, so this researcher called Besson Binder is a professor in one of the US university, and he has been doing a lot of all this stock market research. And he always found the same thing, right? Years and years over and over again, the history repeats. He found that more than half of the US stocks, right, since about 1920s, his studies stretch all the way to 1920s, almost 100 years. Okay, and he found that more than half of the US stocks, right, don't even outperform a 1-month treasury bill returns. Okay, and now treasury bill quite high lah, right? Treasury bill return at 4-5%, but most of the time is like less than 1%. Okay, so which means, right, more than half of the US stocks, right, return less than 1%. Okay, on an annualized basis. That's very, very low. Okay, can't even beat inflation. And that's the odds that we are looking at. So your chances of picking a stock that's going to underperform, right, is significantly higher than if you pick a stock that is going to outperform. So that's why I'm saying that holding a stock doesn't solve your problem. Okay. Yeah. So stop thinking that mistakes will correct itself. It won't. You'll get worse. All right. So it does pay to analyze a stock and improve your odds. Okay, because investing is all about probability. It's not a 100% hit. All that we do, hopefully, our effort is to help us hit the right ones and increase our odds, increase our chances of success. And that's why you're doing all this analysis. Okay. So let's begin with the first strategy, how to increase your odds using certain methods and techniques. The first one is called value investing, which is buy low, sell high to me. Again, there are people with different definition. Okay, but to me, value investing is buy low, sell high, because that's the most classic definition of what value investing is. It's from the Benjamin Graham School of Thought. If you have read his books or you have heard of his name, it's has been around for almost 100 years as well, right? This concept. It's only in modern times people start to link it to Warren Buffett. But to me, Buffett is more of a growth investor than a value investor today. Okay, which we will go through the differences later. So value investing to me, remember, is about buy low, sell high, which means this is a mid-term strategy, which is about 3 years or so. Okay, and that's where you want to sell. All right, you want to sell. So how do you do value investing properly? How do you know when to buy low? You need to know the value of the company. Okay. So for value investor, they believe that the share price is not the valuation. Share price is an opinion. Okay. Actually, valuation is also opinion. Everything is an opinion. But share price is a collective opinion of the investors in the market. Okay. And then to value investor, the business has a value. And the share price may not reflect what the business value truly is. Okay, this is the fundamental core of what value investors believe, right? Share price does not equal to business value. If you ask a technical analysis or a trader, he'll tell you share price is the truth. There is no such thing as a business value. Okay, so you can see, right, different beliefs will have a very different fundamental understanding of how the market works, right? That's why I say you need to know the differences. You need to know who is using what kind of lens looking at the market. Otherwise, you get confused yourself. So for value investor, share price is not equivalent, may not be equivalent to the business value, right? So sometimes the share price may be below the business value. That becomes an undervalued situation. Because the business is worth more, now you can buy it cheaper, it becomes a good buy. Okay, so that's what valuation is. Valuation is trying to determine the business value. If you see the share price $1, right, how do you know it's undervalued? Right, you won't know until you can compare it to something. So in this case, the something is business value. If the business value is $2, then you know $1 is undervalued, right? Because $1 is lower than $2. So the valuation is the process of determining this business value so that you can compare to the share price. Okay, so that's how value investing works. And the second thing is that you need the share price to rebound, or we call it the mean reversion effect. Okay, what mean reversion means is that what goes down too much must come up, right? Like the rubber band effect. Okay, if you stretch the rubber band too much and release, it will snap back to its original shape. So this is also what value investor believe, right? He believes that when the share price is undervalued, eventually the share price would have to rebound to reflect the business value at one point in time. And that's where you sell. Okay, when the share price start to reflect the true value. Right, so that's another fundamental belief of value investor. The share price will have to rebound. Okay, and third is that you cannot just keep holding the stock, because usually value stocks, they don't grow, they tend to be matured company. Okay, so they will go, share price will go up. If you don't sell, share price go down, they go up, go down, go up, go down. And if you bought this low, After 10 years, you don't sell, you might still end up at the same place. So you must take opportunity when it hit the business value, you sell before the share price starts to come down. Because usually these stocks are not growing, their business value will not go up, which means the share price doesn't have this upward trajectory. It's just range bound over a long period of time, but the ups and downs have very big swings, enough for you to capture a handsome profit out of it. So that's why you buy low and you sell high. Okay. And the fourth thing is that it's not that all undervalued stocks you should just buy. Okay. Because for the share price to have this mean reversion effect, right, it must have a event or a catalyst. If an undervalued stock, okay, is an undervalued stock, usually means that not many people are looking at it. Not many investors are looking at it. Not many investors are buying. That's why it's undervalued. Okay. And if there isn't an event to draw the attention of this investor into the undervalued stock, the undervalued stock also remain an undervalued stock. And over time, it becomes a value trap. Right? And if the share price doesn't rebound, then you can't sell. Agree? So what can cause the undervalued stock share price to go up? You need an event. So maybe there was a merger and acquisition. Someone want to buy, another company want to buy over the company, and you have to offer a higher price. Right? And the news hit the investors' world. Then this investor will start to look at the stock, and then you realize that, oh yeah, there's still a chance for us to buy and then sell at the offer price. Okay, so people start to rush in, push up the share price. Then that's where, once the share price hit the valuation, you exit. Okay, understand the concept? All right. Share price don't move up with no reasons, right? There must be an event, and there must be, sometimes it may not be a singular event, it can be just a market bullishness, right? But it's still an event. The whole market is bullish, and that's why even undervalued stocks also go up, because generally there are more investors pumping in more money into all kinds of stocks. Okay, the high tide lifts all boats. That's the idea. Okay, so ultimately there must be some changes. There must be an event to unlock the value. Otherwise, share price will remain undervalued. Okay, so these are the concept of value investing. And these are the common mistakes that I see when people try to do value investing. Okay, the first is that majority of the people are not finance trained, and they may not know how to value a stock. Okay, remember, valuation is very important, because if you cannot determine the business value, you will never be able to know whether the stock is undervalued. It's as simple as that. Okay, and it's just based on other people's opinion, but actually you don't know what's going on. Right? Oh, the guy say undervalued, that's why I buy. Analysts say undervalued, that's why I buy. Okay, I can tell you that most of the time, analysts estimate tends to be rosier than what I think they are. Okay, they are worth. Right? They tend to be rosier. Okay, so it's not all cases that the valuation is right. Right? So it's better that you are able to do your own valuation. Okay, then that's where you also get to know the company better, and that's where you find the confidence in investing in the stock. Okay, so because there's just some work that you cannot do without. Second is, I told you already, there's a tendency, if let's say they make a mistake, investor make a mistake, they tend to hold. And sometimes it's that they didn't have losses, but they just keep holding, and share price go up, they didn't know, because they didn't watch the market, and then the share price come down, and then end up, it's at the same price where they are, so you continue to hold. Okay, so there is a time where you need to sell for a value stock. You can't hold forever, as I told you, because the share price doesn't go up in the long run. Okay, it go up, come down, go up and come down, and it will be range bound for a long period of time. Okay, and then the third one is to buy with the hope of an immediate rebound. Right? Remember, at the end of the day, value investing is mid-term strategy. It takes a few years for the value to unlock. Okay, then that's where you can reap a benefit out of it. All right. So that is the common mistakes that we see in value investing. The next thing is that I want to explain to you, right, what does the process looks like. Then at least you have a better idea what to expect. Okay, because a lot of people say, well, value investing, yeah. But what do I need to do exactly? Okay, I just demonstrate to you how to find a value stock. All right. So first of all, usually I'll use a stock screener. Okay, later I'll run through example for you, run through process with you, but let me explain it first. Okay, so I'll use a stock screener to find undervalued stock. The reason is because most of the time undervalued stocks uh, are less familiar ones, less familiar names. Okay, big cap stocks can also be undervalued, but most of the time, okay, if you compare big versus small companies, right? Most of the time, the small companies have more undervalued stock. And most people only remember the big names. Very few people remember the small names. But yet, most of the undervalued stocks come from the small companies, right? Because most people neglect them anyway, right? That's why the chances of you finding an undervalued stock is higher. So that's why there's no use looking at the media report, look at analyst report, or based on your memory or your friends or family, because most of the time people talk about big companies. Okay, the truly undervalued stocks are the under the radar ones. Those that are not covered in the news, those that are not covered by the analysts, those that are not talked about by your friends and your families. Okay, those are the undervalued, truly undervalued ones. And in order for you to fish them out, you have to use a stock screener. Right? Because I also don't remember the names of what stock are undervalued. You have to use a formula screener to fish them out. Okay, that's the first one. Then once you screen them out, you cannot just buy from the stock screener. Right? You need to look at the details. You need to do some number crunching to determine the value of the business. Okay, the screening is just to help you reduce the number of stocks that you need to look at. Okay, the next is usually once you find a stock interesting, you need to dive deeper. You need to download the annual report. So it sounds very daunting, right? Wow, still need to download annual report and read a lot of things. Not necessary. Okay, usually you need less than 10 pages and less than 10 minutes. You are done already. Okay, the annual report can be very thick, but I can tell you there are less than 10 pages that are important. And the most important part of the annual report is the three financial statements. No matter which company you're looking at, whether they are based in the US, whether they are based in Singapore, whether they are based in Hong Kong, they are the same. They have these three financial statements. Okay, accounting is universal. Right? Of course, different countries have probably 5-10% differences, but generally the accounting principles are similar. Either IFRS based on the International Financial Reporting Standard or based on the US GAAP standard. Okay, but largely even these two standards, they are converging, getting more and more similar. Right, so it is a universal skill. Once you learn this, you'll be able to apply to anywhere in the world. All right. And one of these three financial statements, one is called the balance sheet, and another one is called income statement, and third one is called a cash flow statement. Okay, they may sound very intimidating, very unfamiliar with all these terms and jargons, but let me explain it in a layman way so that you can understand. I'll try to relate it to your personal situation. Let's start with the cash flow statement. Okay, the cash flow statement is like a bank statement, and I believe you have seen your bank statement before. What does a bank statement do? Bank statement tells you how much cash goes in and how much cash goes out. It's exactly how a cash flow statement works. If you know how to read the bank statement, you know how to read a cash flow statement. It's just that they have categories and they have jargons. But the key concept is that how much cash have gone inside the company and how much cash has gone out. Okay, and even a layman would know, right? If a company have a lot of cash going in, it's good. If a company have a lot of cash going out, it's not good. He doesn't take a genius to know that. All right. Next one, income statement. Income statement is like your tax statement. Okay. For all of you, most of you who have been working, right? Maybe there are a few of you as students. Okay. But most of you who are working, you have seen your income tax statement before. And what does it say? It says how much you make last year, correct? And then they'll say that, okay, some things you can deduct. Then this is the amount of tax you pay. And whatever is left behind is for yours to keep. Right? Income statement looks exactly like a tax statement. Revenue of company minus the expenses, different category of expenses, pay the taxes, net earnings for shareholders. Okay. Then the third one is your balance sheet. This looks like your will. Right? You list down the assets that you have and who you're going to will to. Balance sheet, same thing, list down the assets. And then they say, okay, this amount of assets belong to liabilities, this amount of assets belongs to shareholders. Right? Sounds like a will. Okay. And what's the purpose of having these three statements? You think about it. If you get hold of the will, the tax statement, and the bank statement of a person, can you know exactly where the financial situation of the person is? Definitely, right? From the will, you can tell, wow, this person have assets or not, right? Does he have a house? Does he have houses? Okay. And then tax statement will tell you, wow, is he a high income earner? Okay, or expenses also very high. And bank statement tells you whether it's a saver or spendthrift. Right? So if you piece together, you know the person's finances inside out. So that is why companies, listed companies, right, they are obliged to show you these statements. Okay, because they have to be transparent with their details. And so investors can make a better decision. And you think about it, right? If you don't know how to read these statements, wouldn't that put you at a disadvantage to those that know how to read the statements, right? Because if you don't understand, then you know whether the financial institution or company is good or not, right? Whether this is indeed a good company to invest in or not. Okay, so it is a good skill to have, I would say, right? Especially when you do fundamental investing, you cannot don't understand how to read financial statements, one. Okay, right? So you say no need lah, I just look at the ratios, can already financial ratios. Not say cannot unless you use a very quantitative way. Okay, but if you want to pick your own stocks, you definitely cannot run away. You need to learn how to read, like, interpret your financial statements. Right? What is a good set of statements and what is a bad set of statements? Where are the key concerns and where are the good points? All right. So that is where the financial statements comes in. You have to do a valuation, right? Based on the numbers that's presented in the financial statements, pull the relevant numbers out, crunch the numbers. What is the business value? Then you compare the share price. Is it undervalued? Can buy or not? Okay. So now let me just quickly run through an example, right? So that you get a feel of it. Okay. So remember, I'll start off with using a stock screener. So let's just use SG as an example, but remember it's universal. It can work anywhere, US, Hong Kong, Japan, wherever you are, all right? So for example, there are 646 companies listed on the SGX, all right? And I want to filter them. I don't want to look at all 646, very tiring. Okay, I want to increase my chance of finding an undervalued stock. So what do? I use a criteria to screen them out. So typically a stock screener will have many filters for you to use, right? To filter out the stocks that you don't want. But it doesn't mean that the more boxes you tick, the better it becomes. Okay, you must tick the relevant ones, right? Because there are different strategies. The parameters you choose must be relevant to the strategy. Okay, all right. So for example, for value stock, right? Let me see. Give you an example, all right? Like ROE percentage is not really important for value stocks. Okay, ROE percentage may be more suitable if you want to buy growth stocks. All right. So you must also know what metrics matters for a particular strategy. Okay. Like technical traders, they'll look at 52-week price range, right? On the higher side, break new high. But then value stocks will be on the opposite end, right? You want to look at 52-week low. Okay. So the parameters is different. Right. So sometimes it's not that the advice is wrong. It's just that the person's strategy may be different from yours. Okay. But ultimately, you must know what you're looking for. Right. So typically, when you look at value metrics, they are more price versus fundamentals. Okay. For example, P ratio is a value metric. You're comparing the share price against the earning power of the company. Of course, you want to pay a low price for high earnings power as much as possible. That's why you want a low PE. Okay, so the concept is like that. All right. Dividend yield is also a value metric, right? High yield means that you're paying a lower price for the dividends that you're going to receive. Okay, it's always price versus fundamentals, if you realize. Price over book value is also the same thing. How much are you paying for the value of the business? Okay, book value in accounting term is business value. And price over cash flow is the same thing, right? How much price are you going to pay to get the cash flow generated by the business? Okay, so anything that compare price and fundamental is usually a suitable value metric. But I'm not going to use all. I'm just going to use the most classic one, which is price to book ratio. Okay. And the concept is, of course, I want to pay as little price as possible for the value of the business. So I reduce this number. As you can see, if I reduce this number, the number of stocks reduces at the same time. We started with 646. Now we are only have about 460, right? So we can lower, right? And maybe we stop around 0.7. Okay, there's no magic number, right? But you should see majority of the stocks eliminated. Okay, I won't go too low, right? If you go too low, your sample size may not be enough. You might very skewed results. Okay, so that's the concept of statistics, right? So you filter majority out is good enough. Okay, so that's where we will stop. And we will look through the stocks. Okay, right? And then that's where you can find a stock that you find you think is interesting, then you do the valuation. Right? It doesn't mean that all the stocks you should be looking at. Some stocks you can skip, some stocks you are more interested in, you can shortlist them, or you can study them deeper by pulling out the financial statements. But ultimately, you can see that as I scroll down the list, you realize majority of them are stocks that you have not really heard of before. Okay, they are the small companies. And occasionally you may have a big company, right? Like Hong Kong Land, which is a blue chip STI component, right? But you will realize that most of the time, they are uh, smaller companies, right? Not the bigger ones that you see on a daily basis. Okay, and there's also a Jardine over here. Is also another blue chip company, right? But generally, you can see these are very unfamiliar names, smaller companies to begin with. We will probably pick one, right, and do an example. Maybe we can do this PSC Corporation. All right, it is a trading company. It's a food trading company. Okay, can. And we will see one of you ask for US. I will just give you the example here. Okay, it doesn't matter where you use, the concept is the same. I just need to use something that is available here easily. All right. So we'll download this PSC Corporation. Right, December 2022. This is the annual report. Okay, you can see 182 pages, but we're not going to look at every single pages, right? So it's quite easy to understand business, right? Tissue distributor, the Royal Umbrella, Golden Peony Rice, Golden Circle Oil, some noodles, beancurd. Okay, so this is the business. They are distributor, food distributor. And most importantly, we must look at the financial statement. All these are just corporate speak, which is not important, right? So now we are here, and you can see that this is the statements of financial position, which in other words is also called balance sheet. Okay, and this is profits of or loss. This is your income statement. And then the third one is your cash flow statement. Okay, standard. All companies must have these three statements. All right. And because we use book value to filter, right? The most relevant statement will be balance sheet. Okay, so we will use the balance sheet to value the company. Not all the company are suitable to value this way, but I'm just showing you a demonstration. All right. And you can see that the company, right, have different assets. These now different assets. Okay. And not all the assets are of equal quality. Okay, what do I mean by that? For example, inventories means that these are items that have not been sold. And they are selling food products, right? And some food products eventually may get may be expired or may not be sold, and you need to write off. Okay. Receivables means you sold to the customer, but the customer have not paid yet. Can the customer not pay in the end? Possible. Then you may have some bad debt. Then cash, this is of for higher quality, right? Because the cash is already in your bank. Okay. There's very high chance the number will be there. And then investment property also, probably the value will be more stable, right? Basically, the assets are different in the sense that based on their stability. How much can I trust that this number is going to stay there? All right. So let's take out this spreadsheet that I have, and then we start to crunch the number. Okay. And for example, we want to pick out the good ones. 619 is investment property. Okay, cash, I see over here. All right. There's also land and building, possibly under here, right? Property, plant, equipment. We need to look at the breakdown. Okay, we're gonna look at breakdown. So you can see the property, plant, equipment, right? There's furniture, fitting, office equipment. All these are, they don't retain very well. Warehouse equipment also don't retain very well. Plant equipment, oh, motor vehicle worse, right? Depreciation in Singapore is very terrible for cars. Let's see what other asset. Freehold land is okay. Freehold buildings are okay. Leasehold land and building are also okay. This improvement is just extending the lease. Renovation is not worth, right? So maybe the first three columns and look at the carrying amount. So I'll add these three columns together. Equal 962 plus 5047 plus 98629. Okay, so we are pretty much done with the good assets. Let me go back to this. Okay, the rest are just standard numbers like total assets, just copy paste. Oops, there's extra 5. Okay, total liabilities, this number. Right. Let me see if there's any, there's a bit of non-controlling interest. This must be minus away because this doesn't belong to shareholders. And we need to find the number of shares to convert it to a per share value because otherwise the valuation looks too big, right? So number of shares is 500 million. Okay, so if we only take this land and property and not other thing else, we'll get about 10 cents per share, right? Which is a bit stringent. Okay, the rest of the assets like inventories, receivables, they are still worth something. Maybe we'll apply a 50% discount. If we apply a 50% discount, we'll get about 32 cents per share. So let's look at PSC share price. It's about 32 cents. So it's actually a fair value, right? Not very undervalued, okay? But not wrong if you want to buy, but maybe a bit lower is better, okay? Maybe about below 30 cents makes more sense, okay? So that is how you can roughly gauge where the business value is. And you already apply some margin of safety. Okay, we will apply to that because we didn't add back all the assets, we discount all the assets, and we get about 32 cents per share. Share price is also at 32 cents. Okay, so then you know where to enter if you are looking at the stock. All right? Can. Any recommendation for US stock screener? Plenty, right? You can use like Finviz, I think quite popular among a lot of investors. Finviz.com. Okay, over here. All right. Yeah. Will you share out your spreadsheet for taking up the course? Yes, we do. We do teach people how to do the entire thing. Of course, it's not just a spreadsheet. It's to really explain to you how it is done exactly. Right. In this session, I'm just trying to give you a sense how it is done. Okay. There's a lot of details that goes behind it, of course. All right. Yeah, so that is the idea. The 32 cents we can determine. Then you have more confidence, right? Where the value is and whether the share price is worth paying for. Okay, so that is the purpose of doing the valuation. And next is also to know when to sell. Okay, so there are two scenarios, right? First scenario, you make money, happy. Okay, but make money, you also must know when to sell. So for example, let's go back to that PSC example, right? Yeah, you can see the spreadsheet, right? So at 32 cents, where can let's say I bought at 32 cents, where can I sell? Okay, one way is to refer to the book value or the NAV of the company. And this is what the accountant will give you. Right? This is what we have. 32 cents is the conservative valuation that we derive, right? 55 cents is the accountant value that also can be calculated. And which means that this is a known number, and we can sell at this number. If we buy at 32 cents, we sell at 55 cents. What is our potential profit? It will be a 71% gain. All right, 72% gain. Okay, so then you have a game plan. You have numbers, you know the levels. Okay, below 32 cents, I can buy. And if I can buy cheaper, means that my potential return goes up, right? Because if I can buy at say 29 cents, then my returns go up to 89% if I can sell at 55 cents. Okay. And sometimes you can also do a check whether can it go to 55 cents, right? Maybe let's go back to this and look at the history, right? Possible, yes, hit 55 cents before. Okay. Otherwise, the more conservative, maybe 50 cents you can get out. I think you can adjust. You can adjust maybe instead of 55 cents, let's get out at 50 cents. Let's just play a bit safer. Correct? Then this become 50 cents. Okay, then your return will be about 72 cents, if 72% if you buy at 29 cents. Okay, so this is the stage where you start to do your game plan. And this is even before you buy, right? So you know exactly how to go in and exit. And it's almost like, you plan for a mission impossible. You must have a plan to go in and go out. Not just buy first, then we think about it later. It doesn't work that way. The planning has to be done beforehand. Right. So once you have the plan, then you can have more confidence to execute the plan. Okay, so hopefully you get where I'm coming from. All right. At any one point in time, you should be clear about what you're doing and not have to rely on somebody else to tell you what to do, not to like have a lot of self-doubt, and not also to be like gung-ho, I just don't care, I just buy. Okay, so there must be some planning that's involved when you buy a stock. Okay, and sometimes it's also it may not materialize, even though you may have a profit target, right? Unfortunately, even sometimes you do your work, right? You bought a stock and you realize that, oh no, something bad happened, the fundamentals weaken. I don't know, maybe for the company that we look at PSC, then what you realize is that, oh, they have a new competitor coming up, they lost certain distribution rights, right? Fundamentals are weakened already. Okay, the business is not the same as what it is when you first saw it. And then the share price came down. And that's a point where you realize that actually this has deteriorated too much already, right? Maybe initially your profit target was 50 cents, but after you do a new calculation, after fundamentals weaken, oh, it's left 35 cents. Then imagine you bought at 32 cents. Do you want to wait for another 10% to go out, or you just want to get out now? Maybe the share price have dropped to 27 cents. Then you better get out now, right? Because the fundamental value has dropped too much. So there are the plans also can be dynamic because everything is moving at the same time, and you need to adjust them. Okay, so with that, then you know exactly what to do, right? Should I buy? Should I sell? And not based on guesswork, right? Or make money I sell, or don't make money I kill. Okay, which I told you it doesn't work because most of the company, if you hold long enough, they will become worthless. All right, so it's important that you know how to sell as well. Okay. So we're done with the first strategy, which is the buy low, sell high. Okay, the next strategy that we'll go through is buy and hold. So this buy and hold is more related to growth investing. And remember, this is a long-term strategy beyond 5 years. The first one is a value strategy, is mid-term, is about 1 to 5 years, that kind of time frame that I'm looking at. Okay, usually we look closer to about 3 years or less. All right. So different strategy, different approaches, and the things that you look at are also very different. All right, so now let's go on to the growth part. Okay, so for growth stock, you still need to do valuation. You still need to compare share price versus business value. The concept remains. Okay, the only difference is that I put it here as less important. What that means is that if the share price is equal to the business value, right, you can buy already. Don't need to wait until it's undervalued. Okay, the reason is because a lot of all this business, the when it comes to growth stock, right, the business value is more iffy. It's usually a range. Like just now, it was very precise, right? Like PSC Corporation, we realized that okay, it's 32 cents, right? It's one number. But when you look at growth stock, it can be maybe between $2 to $3. It's a fair range, fair price range. It's not precise one number. Why is that so? Okay, let me explain to you. So let's say this is a history of a stock, and this is where we are now. There can be many possibility how the stock value will go in the future, right? We don't know. Okay, it can increase in value, it can decrease in value, it can increase in value at a slower pace. Who knows the future? Nobody knows. But the problem with growth stock is that the value is in the future. Otherwise, why is it called growth stock? It's about the future value, right? So the problem is nobody knows the future and the value. We don't have the financial statements of the company in 2027. We don't have the financial statements of the company in 2030 now. Okay, unless you go back to the future. All right. And that's why you end up typically you have a range of values for growth stock. Roughly there, aga. You cannot be precise with your valuation for growth stocks because it's impossible. Anybody who give you a very precise number for growth stock usually have a thick layer of assumptions. You assume a particular interest rate, you assume a particular growth rate, you assume a particular discounting factors, right? So that's why it is going to be a range of value rather than a specific number. Okay, so that's why I say it's less important. It's not that it's not important, it's just that you can't be accurate about it. Roughly there, fair price, buy. Okay, so that is the idea of growth stock. What is more important is the quality of the business. Remember, just now I showed you the statistics, majority of stocks cannot make it one. Okay, what are the stocks that can make it is really the fundamentals of the business. It must go from strength to strength. It becomes stronger 10 years later, much stronger than what it is today. And then because of the value of the business has gone up so much, the share price have no choice but to follow. Okay, so you need to find what is a business that can prosper for the next 10 years or the next 20 years, whatever investment horizon is. All right. So the quality of business is very important. Okay, because if you buy poor quality business, eventually the performance will suffer and the share price will go down. All right. And when it comes to investing in growth stock, another misconception that people have is that, oh, the higher the revenue growth rate, the better it is. Correct. Makes sense, right? You're buying growth stock, right? Higher growth, higher returns. Okay. It is not just higher revenue growth rate. It's that the higher revenue growth rate must be able to sustain. You don't want to buy a stock, wow, it's growing 50% per year. Wow, very fast, for the last 3 years. Then suddenly next year, the revenue growth dropped to 10%. Means the revenue growth has fizzled out. It is not sustainable. When it's not sustainable, it is not a growth stock. A growth stock must be able to grow and compound over a long period of time. Okay, which also means that usually when you look at a very fast growth stock, right, 50%, 60%, right, eventually the growth rate will have to slow down. As the company grow bigger, the growth rate will slow down. This is understandable. Just like a human body, when we are young as children, we grow very fast. When we are older, the metabolism drops, the growth rate slow down. Right? Otherwise, we grow into a giant. Okay, so same thing for businesses or for companies. When they're younger, they grow very fast. But those high growth rates are not sustainable one. Eventually, the growth rate will slow down. And so you need to determine what is the long-term sustainable growth rate. Right? Which means the mature companies usually give you a better gauge. Okay? To me, growing more than 10% per year is considered fast enough. You don't need 50%. If you can grow 10+% for the next 10 years, you already found a very good business already. It's not easy. Okay, it's not easy for a company to do that, right? Especially your company is already of a big size. Okay, most of the blue chip companies don't grow at more than 10% per year. They grow close to the GDP rate of the company of the country, right? So in the US or Singapore, it's like probably less than 5% growth rate they're looking at. All right. So if a stock can still compound at more than 10% per year for the next 10 years, you will find it is one of the growth stocks you should be looking at. Okay. Then there's also another thing about geographical selection, right? To keep, because this can be a bit lengthy, but let me just cut short for you. Okay, so basically, what I'm trying to say is that before you look at what growth stocks, right? There are certain countries that are better for growth stocks. Okay, and it's not surprising that you will know that US is one of the best places for growth stocks. Right, you see a lot of MNCs from there as well. The reason basically is that the market size does matter. No matter how much you want to argue about it. Okay. For Singapore, the market is just 5.5 million. It's a very small market. And it will force companies to expand, right, using the same product and services to expand overseas, obviously. Okay. But the problem is that the domestic market doesn't give a lot of firepower for companies to expand overseas. It's very different from US, where it's 330 million people, right, to give you a lot of firepower for overseas expansion. So that's why it is likelier that the US company can grow longer compared to a Singapore company. Okay, because the domestic market is a lot larger to support overseas expansion. All right. Once you can keep expanding to the rest of the world, your growth rate can sustain. You see? But if you are in a small country, you're not able to grow beyond Singapore, then your company will not be able to sustain the growth rate. You might grow very fast in the first few years, but then after that, the growth is out. All right. So there must be a big domestic market that's easy for companies to expand. They must also be homogeneous. Basically, the population must be more or less the same, such that they expand to other states, right? They don't need to tweak their business model. If it works for one state, right, it will work for other states. So to capture the entire domestic market, it becomes a lot easier. Okay, so US is definitely one to look at, right? Even Europe, right, is not that homogeneous. There are many different countries in the Eurozone. The culture may be different from one another. The purchasing power is also different, right? It's not as homogeneous as the US. Okay, the other homogeneous country would be largely China, right? It's not all 1.4 billion, it's a coastal area, right? This is a 600 million market. Okay, so if you ask me, if you want to really look for sustainable growth stocks, right, you look at either US or China. So some investors, they are very scared of China, right? Then it's fine. You look at US. Okay, so for growth stocks, you pick at the right place, the right location, right? You already win half the battle. You try to find growth stock in Singapore, you're going to waste a lot of your time. If you find one, okay, every country will still have growth stock, to be fair. Okay, even if you find one, the growth may not be as impressive as one from the US. Okay, so you need to pick, you need to hunt at the right place. Hunt at the right place, your job is half done. Okay, otherwise you hunt at other places, you will take more time and it's going to be more challenging as well. Okay, you may not have enough ideas too. So generally, I would say that Southeast Asian is not a good place for growth stocks. But if you want to do value investing, it works anywhere, even in Singapore. It doesn't matter. Okay, because majority are small caps, right? So you don't need them to grow. You just need them to be undervalued. It's a lot easier to find value stocks compared to growth stocks. Okay, so growth stock, you need to be a lot more stringent. Okay. The other thing that I want to share, for interest of time, I'll jump a little bit here and there, and also for the chain of thought to be smoother. Okay, I keep talking about sustainability of the growth rate. That's very important, right? I want to show you the mathematical proof to it. Okay, for those who are more mathematically inclined, right, you will understand this point, right? It can be a very powerful concept for you. This is a compound interest formula. Okay, your future portfolio value is determined based on your current portfolio value, right? Your current capital. More capital means that your future portfolio value will be higher, right? This is common sense. Okay. The other component is this rate of return, right? If you get higher rate of return from your investment, then of course your future portfolio size will be bigger. The third one is this time. Okay, which means that the longer you allow your portfolio to generate the return, then your future value will be higher as well. Okay, not difficult, right? So these are the three. The big difference is here, right? You know that this is linear. This is also linear. Only this t is exponential. Right? So for those mathematically inclined, you know that anything that's exponential will have a bigger impact on this. Okay, yes, you can put in more capital. Yes, you can generate higher return. They will increase your future portfolio value. But okay, the secret to compounding interest is time. And that's why we talk about long term, because you need time for compound interest to do its magic. Okay, so not many people understand that. People ask, if I can make money short term, why wouldn't I make money long term? Okay, because time is the exponential component to compound your portfolio value, compound your wealth. Okay, the secret to Warren Buffett is not just his rate of return. The secret to Warren Buffett is time. He started investing very young, right? Like what, 9 years old? Right, he started investing, and he lived a long life. Okay, until 90s. Right, he invested for over 90 years, and that is his secret. Okay, to compound that wealth. Of course, you don't need Warren Buffett wealth, right? You don't need his billions. Millions is probably more than enough. Okay, so the secret is actually time. So for growth stock, remind yourself, right? It's the time that is important for the compounding effect to work. Is magic. Okay, so the buy and hold concept, everything hinges on selecting a stock that can prosper for a long period of time. Otherwise, you will not get a compounding effect. Okay? Can I? So a lot of people overlook this, right? A lot of people think that buy and sell faster, make more money. Okay? You buy the right one, you see already, you let it compound, you make more money actually. Okay? So how do you then, of course, know that whether a business will prosper? Okay? Should you buy a company that come and go very fast? Okay. Or Munger call it a surfer business. Because the tide is right, then go, then once it is come down, then you exit. Right? Or you want something that is really I call it a Lindy effect that can last a long time. Okay, of course the answer is this. Okay. I don't know whether you realize this. Maybe I can spend a bit of time to explain this. Why is this a very important concept? Right? A lot of business, right, are not intergenerational. Not intergenerational. That means they capture a generation of customer, right? They cannot capture a younger generation. Can you give me an example? Can you give me an example? Anything you thought of an example? Okay, I give you one, like Levi's. Levi's jeans probably like is the jeans for Gen X. Gen Y people don't care, right? So which means that at one point in time, it is growth rate, right? It cannot find new customer, right? The growth rate will collapse. Okay, this is a bit deeper, right? But I think it's very important to discuss because I think a lot of people overlook that. Because a lot of people like to buy stocks that are very exciting at that point in time, but to only realize that the growth cannot sustain. Then compounding effect will not happen one. Okay. Any other example you all can think of? That it's not intergeneration one. After they capture one generation, they're gone already. Nokia. Nokia is a little bit different. It's because of technology changes. Okay. This is more of tech changes. Not so much of the concept intergenerational. Oh, anything else? Anything else? Do you think Facebook is generational? Yes. If Facebook intergeneration, why do they need to buy IG? Why are they so scared of TikTok? Correct. Yeah, Facebook is more probably X lah. Yes, they do have like Gen X, Y, Z probably all on Facebook, but do they actually really use it on a regular basis? IG is probably more Y, TikTok is more Z. Right? You can see it's not intergenerational. Social media is not. Okay? Social media is generational. Okay. And then there's some come and go one hype for a period of time, then go away, right? I don't know, bubble tea. Okay, a lot of different kind of business you know, 老伴豆花, just talking about it today. Right? Those who are based in Singapore, you know this. Okay, so a lot of businesses you realize cannot last a long time one. Okay, after a long period of time, they just fizzle out. Right? You throw a dart, you hit one stock that's growth rate has tapered off already. Right? So you can realize how stringent it is for a company to be able to grow at a fast rate for a long period of time. It's not easy. And to be relevant for a long period of time is not easy. Okay? So what is this Lindy effect? Linear effect is more like uh it has been around for a long time. And it will be around for longer time. Okay, so it's almost like time proven. Okay, and usually it is generational. In order to be relevant, right, it must be able to capture the next generation of customer. Okay, so now we go to opposite, right? What are some of the companies that you can think of are generational? That means this generation use, next generation will use, next generation will use. This is where your compounding effect will come in. Okay, Jimmy says Sam Corp. Fair enough. Throw rubbish, you still need, right? Okay. So some of you start to think of Coca-Cola. Right? Okay. Anything beside Coca-Cola or not? Anything beside Coca-Cola? Credit card, Visa, MasterCard. What else? Nestle. What else? Fair enough, right? These are McDonald's, yeah. Right. You bring your children, your parents brought you to McDonald's, then now you bring your children to McDonald's. Intergeneration, right? Pfizer, Viagra. Luxury brand. Okay, this is just one aspect, right? Don't take it as, oh yeah, these are the stocks to buy. Okay, I'm just explaining to you how do you determine the kind of stocks that can be relevant for a long time to come and stocks that are not relevant after a period of time. Okay, you can't buy and hold these kind of stocks that much because they capture one generation. Yes, they have competitive advantage, they have a big market share, but it's only for one generation. When a new generation come, don't have it. Same as brokerages, right? Brokerages in another case, very non-intergenerational one. Okay. A lot of cases, a lot of the more senior investors will start with the traditional brokerage, right? Even based in Singapore, will be like Poems, your Maybank, right? They get stuck with their brokerage. They don't really move. Then you have the new ones that come in like Mumu, Tiger, right? They are not interested. But then this will capture the young ones. Right? They grew up in this. Then they'll feel that, oh, I use Poems interface, cannot, right? I'm not used to it. Okay, so this is why most businesses, they cannot capture the next generation. And once they cannot capture the next generation, their growth rate will taper. Okay, because they got no new people to sell to. All right? Can. So that is the idea about sustainable growth. That's the most important concept when it comes to growth stock. Because of time is the exponential factor for your wealth. Okay? So that's why you realize that why suddenly Buffett choose all these stocks, right? It sounds like Buffett stocks, right? All this. Correct or not? You realize? Because that is how the way that he thinks. His idea is time. Compounding effect based on time. Which stocks can last and persist. That's why you need competitive advantage of mode, right? For each generation to continue to choose this company and not switch out from it. Okay. So he said that usually he don't like to predict what will change. He predict what does not need to change. What has been around and what's going to stay relevant is a lot easier. And so they end up with soft drink, candy, shaving, chewing gum, all this kind of thing that does not is unlikely to be disrupted. Technology, a lot of disruptions. Very, very exciting. But it's very little certainty. And when there's very little certainty, you can't compound for a long time. Get the idea? Right? These are the stocks you mentioned as well, right? Okay. And there are stocks that can go very well, very far. But next thing is that we want to throw in another factor, right? Which is the growth rate. Okay, if you talk about Coca-Cola, the revenue growth rate is slow. It has slowed already. Because they're all around the world already. Yeah, every generation only consuming it already. There's again not much room for growth. Okay. Yes, new generation come in, the next generation they will also start drinking, right? Even my kids drink Coca-Cola. Okay. So fair enough, right? But they're not growing fast enough. Okay, they're not growing fast enough. Right? You can see single digit, some even on a negative basis. So I would say that still want some growth, right? More than 10% growth rate. Okay, so I give you an example, right? So this is MSCI. Okay, some of you might heard of it, some of you might not, but definitely you have heard of MSCI index before. So they're indexing company They provide all this index, and then you have ETFs that tracks this index, and then these ETFs will pay money to MSCI to use the index. So it's not free one. There's a royalty needs to be paid, and usually it's a fixed fee or a percentage of the assets that they manage. Okay, so the next thing is that indices, right? Has it been around for a long time? Yes, more than 100 years. Right? Dow Jones was one of the earlier ones. Has been around for more than 100 years. And today, do we still need index? Yes, actually more than ever because of all these ETFs. And fund management, active fund managers also need to benchmark against these indices in order for them to compare their performances. Okay, so these indices is likely to be very evergreen, right? In the next 10 to 20 years, it's going to be very relevant because there will be likely more ETFs and not less ETFs. Then MSCI also have the ESG indices, which is also another trend that is important. Okay, so indices is unlikely to go away, right? And financial data services, all these are unlikely to go away anytime soon, right? And on a day-to-day basis, we are also using indices, okay, to give us a gauge whether the market is up and down. Right? We don't look at every single stock to determine whether the stock is go up or down. We usually look at index. Okay, so that is how indices are likely to stay relevant for a long time to come. And it's an oligopoly market, right? Typically, when you buy growth stocks, they are oligopoly one. Not a perfect competition. Okay. These are economics terms. So those who have taken economics, you have remember vaguely what this means. Perfect competition means that a lot of company, okay, all trying to use branding to differentiate themselves, right? Not a lot of margins. Everybody is fighting one another, zero-sum game. Oligopoly, usually only a handful of companies. Okay, so usually a good growth stock is in the oligopoly market, not a perfect competition. All right. MSCI is one of the big three together with S&P and FTSE. Okay, they dominate the index market. 5-year annual growth rate is still about 12%, right? Still rather high. Okay. Don't look at the yield. This is the dividend. I just wanted to show you that they also give the dividend growth. Okay. And I want to show you the consistency of the growth. That's the more important one, right? Remember, you want time to you want the returns to compound over time, right? So given enough time, it must show very steady increase, okay? And it also show the resilient growth of the company. Why is it important to see, especially in the past few years? Because you have COVID, and in 2020, it still raised dividend. Tell me how many companies can grow in 2020 when the world was shut down, and how many companies can still give higher dividends, generate higher cash flow, and give higher dividends during a COVID year. Okay, it's the best test of resiliency of a business, right? Because indices business is not affected by whether people go to work or not, whether people function properly or not, because your financial markets are still working, your financial markets are still moving, right? So it's resilient. And over 16 years, you have 20x. Okay, you can see the compounding effect. This is the hockey stick that we're talking about. Okay, hockey stick effect is visual version of compounding effect. This kind of stock, don't bother to like, oh, I want to make 10% here, 5% here. Don't waste time because the big money is in the sitting, is in the holding. Okay, it's the exponentiality of the stock that really built the wealth, right? 20x, 21% per year for the last 16 years. Okay, can. Next one, example, right? I also want to give you the other side. Okay, China. I know some people are, I don't want to buy China stocks. Okay, but I want to show you that actually China stocks are going faster and you do have good performance, right? So Maotai is the one of the top brands for baijiu. Baijiu is a type of spirits that is mainly drank in China. It's drank for thousands of years, right? It's not new. The brand is new, but baijiu itself is not new. Okay. And largely drank in China, which means there's a lot of room for internationalization, right? Only 4% of revenue is overseas, right? 96% is drank in China. So there is room for cultural exports for the rest of the world to increase its demand. Okay, 5-year growth rate is at 22% per year. right? It crossed the 20% mark. And MSCI was just at 10%. Okay. And same thing, this is the dividend, right? Per year, steadily growing. Same thing during 2020 and China lockdown longer, right? 2020 open up, then after lockdown again during 2022, okay, this period. Yet increase dividend, and increase dividend. And why I want to show you dividend is because these are real cash. Because some people say that, yeah, look at revenue can be fake, profit can be fake, but this is real cash. They double the revenue, they double the dividends payout. Okay, because there was a special dividend. Likely this year, 2021 also a special dividend. Instead, every 10 years they got a special dividend. Okay. Otherwise, they actually increase the dividend every year. Okay. So the dividend is also increasing at 22% per year, right? Quite in line with its revenue. Okay. So which means that the cash does flow in tandem with the revenue. And this is the stock return. 22 years listed, 21 times return, 29% return per year. Also a hockey stick return. Okay, can see? All right. So there are opportunities, there are good stocks out there, but there are not many of them. Okay, and you need to understand the concept uh, of all this sustainable growth, right? That can prosper for a long period of time. That's where compounding effect comes in. And it's not just I find the highest growth rate, highest revenue growth rate, I get the right stock. It's not like that. Okay, you have to think a little bit deeper and to find the right ones. Right. So you realize that you end up probably closer with what Warren Buffett has been saying. Okay. And that's the secret to his strategy. Right. And the last thing that I also wanted to show, right, is that I give you an example like MSCI and Multi, they actually give dividends. Okay, the dividend yield is not very high, right? But they can be a very powerful driver of returns. Why? Okay, we take an example of this, right? So for example, let's say you buy a stock on 21.4, okay, and you get 1% dividend yield. Not very high, right? Okay. Then next year you realize that it grew 22%. So you get 1.22%. Your dividend yield actually goes up. So as the years goes by, your yield goes up. And you did not do anything. You just bought the stock 1 year and you sit there. Every year you got pay raise. Sounds good, right? As a shareholder, every year you got pay raise. Every single year. By doing nothing. Okay? In work, you may not even have pay raise. Okay? But yeah, this kind of stock give you pay raise every year. Pass you more cash every year. Right? Quite powerful, right? And let me ask you, right? When they give you more dividends every year, what do you think will happen to the share price? What do you happen to the share price? If a company can keep giving you higher dividends, what do you think will happen to the share price? What do you think happen to the share price? They'll say drop. How? Yeah, it's up, right? I will show you already. Okay, why is it going up? Why is the share price going up? Okay. So technically, it's not wrong that to say that once the company gives dividend, the share price will drop. It is true. Okay, but the fact is that when they're able to give more dividends, their business value has gone up because the ability to generate cash has gone up. So when the business value gone up, that is why the share price go up as well. Okay. So when you have dividend growing, right, you will get both dividend gain, okay, because your dividend keep going up. You also get capital gain because your share price go up. You actually get best of both worlds. So I give you some mathematics, right? If you bought a stock at 1% and it compounds at 18% per year, the dividends are over a 20-year period, your yield, dividend yield in the 20th year will be 27%. And if you don't sell next year, it becomes 30%. So your yield keep going up and up and up. And don't forget, this 20 years, the share price will have gone up significantly, many times your purchase price. Okay, so the characteristic of growth stocks looks like that. Yeah, I hope you get a picture, right? Which are very different from the value stocks. So these are common mistakes that I see in investors pursuing growth stocks, growth strategy, not stringent enough, right? Especially is the when analyzing the business, whether is the business good or bad. Okay, because sometimes don't know how to see, don't know how to analyze. Is this important? Not important? Don't know, right? Or maybe focus on the wrong areas of the business. Look at the sexiness of the business rather than the sustainability of its growth rate. Okay, so I hope today you get a better focus on where that important aspect is supposed to be. Then sometimes sell too early. Okay, right? Imagine look at MSCI, right? Imagine maybe you bought $100, then you sell $200. Okay, or maybe 150 lah when the market corrected, right? During COVID, wow, scary, 150 sell. Right, make 50%, not bad, right? Okay, but you kill yourself because eventually it become 600 or even this ending point is like 550. Okay, you have made 4x already. Right, common mistake. Sometimes it's not that people didn't pick the right stock. Sometimes they pick the right stock, but because they make money, they thought they made enough, they run. Then they miss the bigger gains. Then you will hear, "Aya, I used to have this stock before. If only I held it." Okay. Because make money sell, right? Lose money keep, right? Okay. So that's a problem. And sometimes it's you make a mistake. Okay? It doesn't mean that you try to do all these things, you will pick the right one. Sometimes things deteriorate and you don't want to sell. Okay, then it just waste space, waste capital locked up in a stock that's not growing anymore. Might as well sell it and put it to a better stock. Okay, and lastly, don't know valuation as well. Don't know what is a fair price to buy. Is it overvalued, undervalued? Like MSCI is overvalued. Okay, I also think Multi at the current point is overvalued. Okay, so you must know where is the price going. Right, so valuation is needed. Okay. So today, these are the two strategies we have discussed. Okay, one is a medium term, which is a few years, which is the value strategy. It's about buying low and selling high. Valuation is important so that you know where is the undervalued price. Okay, and you need to make sure that there is an event or a catalyst that can cause the share price to rebound, so you can sell it for a good profit. Don't hold, you must sell. Then we talk about growth strategy. It's 5 years and beyond, right? That's my definition of long term. This is the stocks that you should hold, right, for the compounding effect to happen. Okay, and usually not many stocks can grow sustainably over a long period of time. So which means you need to be stringent and choose the right one. And you need to think Lindy effect so that the company can be products or services can be relevant for the next few generations to come and for the rest of the world as well. Then that's where the growth area comes from. Okay. Valuation you still need to do, but you cannot get a very precise number because the value in the future, nobody has a crystal ball, nobody have a financial statement in the future today. So you need to make some guesstimates and roughly there, fair value good enough, you buy. Okay, so very different concept. And that's why I think it's important for people to know what you're doing if you really want to pick stocks. You do need to really understand what is things to look out for and how do you choose stock based on a particular strategy. And don't mix strategy, okay? There are certain reasons why certain stocks are picked over another when using a particular strategy. You must know when to use what. Just like a box of tools, right? Sometimes a hammer is needed, sometimes a saw is needed. You must know when to use the right tool. Investing is the same. If you don't even know what tool to use, then I think it's important to learn, all right? And that's where I want to share with you investing program that I run so that if you are interested, you can consider this. This is the Intelligent Investor course. Okay, so this is the course that I'll teach you both strategy, right? Which I went through today. One is the value strategy, one is the growth strategy. Okay, so I'll explain to you in detail how to do it step by step. This is like a map of a roadmap of what we're going to cover. So it's a lot of things. Right? So you might find that today I share some of the stuff that you find useful, but there's a lot more things that I didn't share with you, which I think that it will help you with the detailed steps of how to actually do value or growth investing. So it's a step-by-step formula will be given to you. And example, right, of even beginners are able to pull this off, right? Because we have run this for quite many years already. And we really want to equip people with the right skills to do investings and to invest in their own stocks, right? Picking their own stocks. So we used to run this program before COVID, right? At this LTC building, and MacPherson MRT, I think. All right. And it was originally belonging to a listed company. Okay, so after the first day, they learn the first strategy, then I ask them, okay, go back and practice and see whether this company is undervalued. So some of them use what we have taught them, right, to do the valuation. And then the next day they told me, yeah, it's undervalued. Some of them bought it. I remember this is the luckiest guy because he bought at 60 cents. Then 2 weeks later, he got a delisting offer at 90 cents, right? There was a catalyst, an event, because the management offered to buy and privatize the company. So that's how someone without finance background could immediately do it and identify an opportunity. Okay. So this is also on LTC, different people of different background, right? They were able to also see and apply the strategy to pick the stock. Okay. And most of our graduates are not from finance. Okay, and that's why they find value in learning the skill, right? They want to have the skill to identify which stock to buy for their own portfolio. So this guy, Cheng, he works in the hospitality sector and he got a few good picks, right? Ellipsis, Nunki Bermuda, his first 100%. We didn't even buy this, he bought it himself. This is a value stock. And Powermatic data, this was 150% return for him, right? So he was just basically following the strategies, okay? So basically, with the strategies, with the steps that's given to you, you will know which stock to buy, hold, and sell. So it's not based on guesswork anymore, right? You'll be equipped with the skill, and it's not. And of course, you try to get rid of the crappy stocks that if you used to have them. With these strategies, you will know how to avoid them. Okay. So this is the Intelligent Investor Program. I call it I2 program. So the bonus, you get a course, and the bonus one is that the step-by-step investment formula, right? So that you know how to proceed with your investment. It's like a checklist, okay? Second is you get a valuation calculators, which I showed you just now, right? And it's very simple, okay? We will teach you how to use it, of course, and what is the intricacy of every numbers. And that's where you copy, paste, copy, paste, copy, paste. Okay, less than 15 minutes, you will be able to get the value of the company. Right. So I'll teach you how to do it, not just for the value stock, just want to show you value, right? I didn't show growth. So value have a spreadsheet, growth will also have another spreadsheet, okay, where we determine the fair value range of a growth stock. Okay, so I'll give you both templates and I'll also teach you how to do it. All right. So you'll be able to know what is a good price to enter. Okay, so finally, you have the skill to understand how to do a valuation. You know whether the stock is undervalued, fairly valued, or overvalued. Okay, so then you know what action to take appropriately. So these are what you're going to get, right? I2 program, which consists of the 2-day course. Bonus one is the step-by-step investment formula checklist. Bonus two is the valuation calculators. And the next bonus is regarding the stock data. Okay, so the good thing is that today there's quite a lot of stock data, but there are some stock data that may not be available so easily, right? But I will show you where to get the data, and I also will give you this 13,000 stock data base, right? It covers US, China, Hong Kong, as well as Singapore. These are the 4 markets, and all together add up is about 13,000 stocks. Okay, so a lot of all these parameters I'll give you also the ranking. Yeah, I'll teach you how to use the ranking. And then you can filter using Excel spreadsheet anytime you want to find ideas, right? I'll teach you how to screen as well. Then you will be able to get these trade ideas a lot faster than what you used to. Okay, so you get the stock data all in one place, right? And you don't need to pay for any data subscription fee. Okay, I'll show you how to find the data with this 13,000 stock database. And fourth is that I also will give you more resources to help you as a DIY investor, right? To make it easier for you, right? I have this monitoring system. how I keep up with a lot of things, right? Is that I have a system that feed me the information, and I want it to help you build this system for yourself so that you are able to get the right information at the fastest possible way, and it's free. Okay, you don't need to subscribe to Bloomberg, you don't need to subscribe to CNBC, you don't need to be paid one. Okay, in fact, the fastest informations are free. You'll be surprised to hear that. Right. So there are a lot of this kind of announcement by companies that tools that you can use can be like SGX app. In the US, you have Cap Edge. So I'll show you all these resources. And you sign up for this, you put in the stocks that you want to monitor, and they will start sending the alerts to you whenever the companies you look at are having a certain developments, right? So I'll give you a stock research resource list, okay? Whether is it to get data, whether it's that stock screener, which stock screener to use, where to get annual report, where to get analyst report, where to get company presentation, transcript, announcement, valuation ranges, stock chart to use, earnings date, Fed fund rate, some of the macro data. Okay, so I'll give you a full list of resources, all free one. Okay, and that will become your information center. All right. So number 4 is our stock research resource list. Okay, and the 5th is that after the course, there will still be support. Right, I'll give you 1 year of support, my personal contact, okay, email, right, and I check my email every day. One. Okay, so the best is that you ask me and you send me. So a lot of them, based on experience, usually they send the whole spreadsheet to me. Okay, because usually it's the valuation they are not so sure. Right, they did correctly for this stock. Right, so I will check through. Right, you can see my reply is very detailed. Tell you where the mistake is, and then hopefully from there you learn. Okay, so it's not just during the course while you must get it right, right? So if you didn't grasp 100% after the course, you're still able to ask me and I'll reply. Okay, so this is another example of a computation. All right, so I'll give you that personal email of mine that you can email me and I'll reply to you. Okay, and of course I'll know a lot of people email me every day lah, right? So I know whether the person has attended the course because of the jargons we use. I will prioritize the people who have went through the course and have questions about the investing strategies. Okay, so bonus 5 is year-long post-course support. This is what you're gonna get. Maybe let me just quickly repeat because there's quite a lot of things here. First is that you get a 2-day course, right? After Intelligent Investor Program, you learn 2 strategy, 1 value strategy, 1 growth strategy. Bonus 1, you get a step-by-step investment formula, right? Both for the value and the growth, right? So that you know how to follow the steps. Because you won't be able to remember everything, right? Just follow the checklist. 2 valuation calculators, which are the Excel spreadsheet. You just key in the figures, copy and paste the figures. The valuation will compute by itself. Okay, the formulas are all inside. Bonus 3 is 13,000 stock database because sometimes you need certain data input into the calculators as well. Instead of searching all around the place, you can just use the Excel spreadsheet I'm going to give you with all the fundamental data inside. Bonus 4 is a stock research resource list. This is where I talk about getting good information, fast information via free methods. Okay, and you can build your stock monitoring system using this list. Number 5, I'll give you my personal email, which you can ask me any question regarding the strategies, regarding the markets. Okay, I'll reply you. All right. And there's even money back guarantee. Okay, because if you ask me whether this program is suitable for you or not, I don't know, right? Definitely, even most of the time are beginners with no finance backgrounds, they can able to do it. So I don't think if you are a beginner, you can't do it anyway. I don't think that's a concern, right? Because most could do it. But to assuage your concerns, okay, so this is how the money back guarantee works. You enroll for the course, and then by the end of the first day, right, because there's 2 days, right? At the end of first day, you already attend half of the course already. And you tell me that, oh, I don't understand what you're talking about. This is too difficult for me already, okay? Or this is not helpful for me, right? You can ask for refund. Okay, so this is something that to assuage your concerns, right? So actually the risk is on our side, right? Because I'm going to give you more bonuses if you sign up within today, right? So the first is that this Growth Dragon investing course, this is more for the China side, right? So for some of the investors, they are still interested because they see that it could be potentially the biggest economy in the world in 10 years time or so, right? So there can be tremendous opportunity to unlock there. But China investing is a bit different, right? So this is where I will give you the top-down, ground-up aspect of investing in China and where to find information in China. Okay, so this is a full-fledged course. Okay, for those who are interested in investing in China, it's a recorded course. If you sign up within today, I'll give it to you. All right. Second is this personal finance masterclass. This is conducted by one of the Dr. Wealth co-founders. You might know him, Louis, or you might have been using his services before. And he is a professional in the industry, right? Finance industry. So he came up with this personal finance course to share what the industry planning strategy is, right? So that you know how it is done, and you also know whether your advisor is smoking you or not. Okay, this is not to replace your advisor. This is just increase your knowledge so that you can understand as well what is suitable for your context. All right. So this is the full thing. Okay, so I2 program, 2 days course, bonus 1 step-by-step investment formula given to you, bonus 2 valuation calculators, bonus 3 13,000 stock database, bonus 4 stock research resource list, bonus 5 year-long post-course support. And if you sign up today, I'll give you the Growth Dragon investing course as well as the personal finance masterclass. Both of these are recorded course. And the best is you can complete them before you come for the 2-day course that is happening on 28 and 29 October. This is not a webinar. This is a face-to-face session. Okay. And I'm not going to charge you 10,000 for the course. I'm not going to charge you 5,000 for the course. And I'm just giving you a very special offer because my staff remind me today is 10/10. Okay. So the special offer is 1498. All right. Very soon we'll not run this price anymore. Okay, so this is your last chance. And 10/10, okay, as of end of today, right? Until end of this midnight, okay, I'll offer you this very special price. And there's also a money back guarantee. Okay, remember, if after the first day you have gone through the class and you feel that it's not suitable for you, you can still ask for money back. Okay, and this is the first face-to-face full class that we are running, right, since COVID happens. Okay, so if you are one who really prefer face-to-face learning, which personally I do, right, because I believe that face-to-face learning cannot, it's still better than webinar learning. That's my personal preference, but I don't know about you. So I do value this kind of face-to-face session a lot more. So if you, we may not run a full face-to-face class in the future. We are just, we thought that since likely this is the last class of the year, we want to run a full physical one. So do take your chance, this opportunity to come for this, right? It's really a very special offer that we are doing this time around. All right. So you're interested, there's a link. You can log in the special price immediately, okay? Because it's a physical class, which means that there's also a limit to the number that we can have. Typically, a class size is max we take is about 30 plus 40 max, right? We don't want to go very big for physical class, right? Because harder for me to speak up. Yeah. All right. Mihua has a question. I'm keen, but I need to confirm if my company will be able to sponsor this before I sign up. So may I ask for the promotion to be extended for me till Friday? Thanks. Special offer. I give you one way, okay? You can log in the price first, right? Then you can ask your company. Then after that, if cannot, you can let us know. We can do your refund, right? So we are flexible with that. Okay, so I because we also need to plan in advance this end of the month already. We need to gauge the numbers properly because we also cater for lunch, right? So we have to get the numbers as quickly as we can. Okay, so that's why there's a bit of urgency in this, right? We are in the middle of October already. Okay, yeah. So this is going to happen in 2 weeks' time. All right. Then, if there are no questions, and I will end today. I hope that today's session is useful for you. Right. Of course, I would love to have you at the program. But even if you do not, I hope that today's session is something that you can take away a thing or two and improve your investment process. Right. So at the end of the day, we are here to support investors. We're here to help investors as much as we can. Okay, so that is the still the mission of what Dr. Wealth is about. So thank you for attending, right? And offer lasts until today. Okay, the link is there. We'll probably, not sure whether we'll email you the link now, but you can just keep the link one way or another. Thank you very much and good night.